let's continue from where we stopped. So we've looked at most of the threats that are commonly tested in the examination, and our engagement is really encouraging. I really appreciate the engagement. I also picked one or two thoughts, and I learned from our engagement. It's actually encouraging. Thank you so much for sharing those wealth of experience with us. All right, so let's try to see how to run so that we can, most importantly, see how to finish up the topic, then go into past questions that speak to rules of professional conduct and how they are tested, just like we did chapter 2. So there are areas of specific threats and guidance to how to mitigate those threats. Areas of financial interest for accountants, talking about the assurance team and family, providing the audit shouldn't hold direct or material interests, and also indirect interests with the client. So is either to dispose of those interests or remove the team member that has those interests. So for example, there was a case of a manager, an audit manager that was provided to a client, specifically the Big Four. And when he got to know that he was provided that engagement, his wife works with the bank where he's to audit. So immediately he declined the job and said, no. He would like to. He works with one of the Big Four. So you can see he removed himself from the team that was auditing that bank because his wife works in the bank, to avoid any interests of all kinds. So that's a way to mitigate or put safeguards to a lot of these threats for accountants that are very objective. This is very important. Then speaking to loans and guarantees. Loans and guarantees. We need to avoid loans and guarantees to and from clients, especially normal commercial terms from banks, especially when you have to audit that bank. Of course, if you're not engaged in the audits, you could take a loan, you could guarantee a loan, but when it comes to engagement, this must be avoided at all costs because they breed conflict of interest. Also, close business relationships. We need to avoid material joint ventures with clients we are auditing. Any arm's length transactions, they are okay, but close business ties should be avoided at all costs. Very, very important for auditors. Well, arm's length transactions are okay in the sense that they are afar off and they don't really have an effect to some extent. And that is why they are allowed in professional practice to some extent for auditors. Yes, so they are generally considered okay. And in fact, they are encouraged both in accounting and business ethics. They mean the parties are acting independently and in their own self-interest without any undue influence or bias, especially when it comes to the audit job. But then any close business relationships, any material joint ventures or joint business together with a client and an auditor should be avoided by all means. Also, commercial transactions with the audit team must be normal in the course of business. Arm's length are not material, but the commercial transactions must be normal and you must maintain professionalism for both parties, management and the auditor. Another significant area is family and personal relationships. So to assess individually, immediate family in influential positions requires removal. Like I told you about that engagement lead that removed himself because his wife works in that bank and she's a significant person, a senior manager. They had to remove himself from the engagement. Then employment with assurance clients. A former key audit partner joining the client requires 12 months. So Sammy spoke about cooling off period. So that cooling off period is 12 months and non-involvement in that period's audit before he can take up an employment with the organization. So he needs 12 months cooling period, 12 months cooling up gap based on ICAN's provision for auditors in practice. And disclosure of the job negotiations is required. So after 12 months, an auditor can work, take up employment with a client, and that's the cooling off period. And also the recent service with assurance client, rotational rules for engagement partners is 5 years, and for quality control reviewers 3 years, and for key audit partners 2 years. This applies to auditors or accountants in practice. So the rules for engagement is for a partner 5 years to rotate that partner. So if the firm must continue the activity, which mostly best practice says that the firm should cede the audit to another firm. But if the firm must continue or they are employing the global 10-year rule, another partner has to take over after 5 years. That's what it means. That's what it means. So please, Grace raised her hand. Please feel free to interject. Please go ahead, Grace. Go ahead. I didn't see it. I just saw it now.
Please, mine is a question on this 12 months cooling off period. For employment.
Yeah.
Let me paint a scenario. Do you mean that, like, for instance, if I'm working with the Big Four now, as an audit engagement staff, and we are auditing like Dangote as a client, and then I want to change my employment to Dangote. Is it that, are you saying that I need to withdraw from or resign from the Big Four and stay unemployed for 12 months before I can be employed by Dangote? Or what exactly are you saying about that 12 months? Who is supposed to wait for that 12 months?
Okay, good question. So if you listen to Sammy very well, it's a cooling off period, and it doesn't mean staying unemployed. No, that's not what it means. So you need to stay off that period's audit. So if an audit is going on involving you, you have to stay off for 12 months. You can take up other audit engagements with the firm, with another company. But if you are sure of working with Dangote, like you said, you cannot audit Dangote for 12-month period with that Big Four entity. It has to be 12 months. So they may assign you to another company. Then after 12 months, you join your Dangote. That's what it means. So you don't have to resign from the Big Four. If the Big Four has shown interest to you, you've disclosed to your head, the head of the engagement, it's fine. It's just to move you to another client. Most Big Fours have a lot of jobs. In fact, the jobs are more than they can cover. So they just reassign you to another job and not Dangote. And when the 12-month cooling period is on or over, you just move to Dangote. That's what it means. It doesn't mean you should resign. But for key audit partners, they too have to leave the engagement, disclose to the engagement partner, and leave that audit engagement to another one. So it's mostly for key audit partners and also staff, because the international standards on quality management and also quality control states this cooling off period for most of the audit team that want to join another firm. So in answering, it's not about resigning. It's not, you will now stay 12 months without a job. No, that's not what it's all about. Yeah, I hope it's clear. Hello, Grace. Is that clear a bit?
Okay, thank you.
All right, you're welcome. Okay, so speaking to
yes, please. Thank you, sir.
All right, you're welcome. Okay. So speaking to fees, I was talking about the mandatory rotation period for the quality reviewer and the engagement partner and the key audit partner. So speaking to fees, high percentages of fees for amounts greater than 25% for 2 consecutive years requires disclosure to governance and review to avoid overdue fees. So what does this mean? If 25% of the revenue comes from a particular client, and it has happened for 2 consecutive years, then that has to be disclosed to governance. And what the audit firm does is, if they find out this, a significant client provides about this amount of their fees, they disclose to FRCN to avoid overdue fees, for consecutive years. And if they are not being paid, it has to be disclosed. So payment and also a client having a chunk of the amount of your fees as revenue could be a significant threat. So that percentage of fees must be disclosed, whether unpaid or a percentage of your revenue that is much. Then inducement. They are mostly gift and hospitality policies. For material ones, auditors are not to accept gifts from their clients, especially significant ones, except insignificant ones, maybe hampers, gift cards and all that. But significant ones that could be cloud judgment and they are consequential must be declined by auditors. And the significance, you must look at it based on your judgment. So there are some inducement, no, this is to really silence you. This is shut up money or shut up inducement. Auditors know that based on the magnitude and the significance or materiality of those amounts provided. In areas of actual and threatened litigation, it may require resignation. Auditors may have to resign. When you are threatened with litigation, when you are threatened by a client, you are intimidated. There are some intimidations, you have to resign the engagement to keep your objectivity and your name to some extent. Also, provision of other audit services can threaten independence, like we've spoken generally to all the threats. And also prohibition on assuming management responsibility is very, very clear. The profession is clear, ICAN is clear, IFAC is clear. We need to stay clear of management responsibilities. Allow management to do their thing, and you just do your job as the auditor. Also, preparing accounting records, financial statements were prohibited for public entities. For public interest entities, is allowed for others with safeguards, in the sense that you can prepare, but you cannot audit. So for public interest entities, currently in the current dispensation, it's not allowed. But for other public listed companies, yes, firms could be provided or asked to prepare financial statements, but they can't audit it. That's what it means, being the judge and the jury at the same time. So it's important to take note of this safeguards. Then temporary staff assignments is allowed with strict conditions. For short term, 1 to 6 months, 6 months to 1 year, and prohibited services for management decisions and client directs. Yes, please, Toluwani, go ahead. Your hands are up.
Good evening, sir.
Yeah, good evening.
I noticed that from your presentation.
Yes, please.
These guidelines are for public organization.
Yeah.
What now private companies? Who regulate them when it comes to private organization?
Yes.
What between them and the external auditors? That is my question, sir.
Okay, thank you very much for that question. All right, so mostly the public organizations are almost the same with the public or the private organizations. It's just that recently the updates were targeted at government entities to really regulate a lot of issues that are permeated around the public space. So for private also, most of these guidelines ensue, but there are some specifics that are directed to the public. So generally, who regulates, like your question, is the FRCN. The FRCN by the laws of CAMA, and some are regulated also by CAC and SEC. But generally, it's the FRCN that regulates this. And they really came after public interest entities and also public listed companies because of one or two shaky issues that were discovered in the audits of the financial statements. So there were not much private scandals or issues in the last, let's say, 5 years, because we noticed that private companies are generally run better than public companies from what we saw in the FRCN's recent report. So in answering your question, the same laws applied, but more stringent on public interest or public listed companies. Yeah, the same law applied to both of them, the private and the public. But then also the private speaks to the size. For example, the small companies don't really require audits. It's not mandatory. It's a voluntary thing for them. But for small and medium scales businesses or companies, some do. Then for big ones, it's also required for private. And that's where the law also applies. I hope you're okay with my... Yes, please.
Thank you, sir.
All right.
Also, sir.
Yes, please.
From my experience, I've noticed that my question goes straight in this form, sir. I noticed that some external auditor, when we talk about familiarity threat, conflict of interest, inducement, does the external auditor have duration when it comes to auditing of an organization? Because I've seen that in a typical business environment, external auditor can spend up to 3 to 6 months in that organization. They will give them an office. Does they have duration to stay? But for me, you stay in an organization for duration of 6 months. There's every room for familiarity. There's every room for conflict of interest. In practical world, I've seen that external auditor can stay in an office. They will say they are doing auditing. They will give them office. They will spend up to 6 months. What can you say about that, sir?
Okay, thank you for that.
Familiarity, and apart from familiarity, there can also be conflict of interest in that regard.
Yeah, I agree with you. I agree with your thoughts. I've not experienced any of those scenarios. As a matter of fact, I do complain that the external auditors don't come physically until end of year stock count in my own experience. So I'm surprised to hear that they will go to an office and stay 3 to 6 months. I've worked with the Big Four, and most of the time I even complain, are you guys not coming? They will just come for end of the year stock count and they will go. And I'll be like, how can we be paying you guys these heavy fees and you just come 1 day, 2 days stock count? And you even do sampling, you will not do full scope. You just do sample and go. Yeah, say they will now tell you it's because there's internal audit and we rely on the work of internal auditors. I'll be like, why? Okay, but then in answering your question, 3 to 6 months, in my opinion, I think it depends on the judgment of those auditors. Some can stay that long and still be objective. It now depends on their objectivity and how the work permits. So there may be some clients that need that physical presence to be able to experience and understand their business, understand the environment. And some firms are slow learners. So I don't know if it's the Big Four you are talking about or the Big Five, the Big Six, or small and medium scale of audit firms or smaller audit firms, and co, maybe 1 or 2 chartered accountants in those firms. I don't know which area or which type of firm you're talking about, but then for a firm to stay 3 to 6 months, wow, that must mean they have to really safeguard familiarity threat. Of course, you can stay that long and still have safeguards, do your job objectively. That threat, no doubt, will be there since you may be familiar with the business, but then your objectivity in trying to be independent in mind and appearance also appears to the person, it appeals to those engaged in the activity. So in answering your question succinctly, yes, they may be bedeviled with the familiarity threat, but how they handle it really matters, and the resultant effect from their reports will really show that they are objective based on the output they bring.
Thank you, sir.
All right, you're welcome. But I have not really experienced them. In fact, most of the time I complain that the Big Four, they just allow us do the job and they prepare reports and collect big money. That's even my complaint. I hardly see them come around, maybe because they feel they have competent hands. Then for me as an internal auditor, the Institute of Internal Auditors Global don't have a rotation for internal auditors. So internal audits, you see some stay 20, maybe even 30 years in a company. I don't think, in my opinion, that internal auditors can stay objective if you stay 10, 30, 5 years. I have a mentor, he's in Canada right now, and he will tell you he cannot stay as an internal auditor in a company for more than 5 years. He used to humorously say, to avoid see finish, Gabriel, I dey move. And I agree with him. In my current role, I've not stayed 5 years as internal auditor. This is my third place working as internal auditor, and I've not stayed up to 5 years. Now, that's our own personal safeguard. You know, it gets to a point with management, they are used to you. Is it not the same audit findings? Is it not the same thing? He will not sign. They are used to you. So don't stay too long. It's my advice to internal auditors. I stay 5 years. I move to another engagement. In fact, as I'm approaching 5 years, I begin to apply. I begin to try to get another engagement to move, to safeguard your reputation, to also stay away from familiarity threat. Of course, for internal auditors, there is no law that says you should move. There's no rule or standard. It doesn't apply to internal auditors, but inflict or impose that. I impose that for myself as a personal choice to avoid familiarity threats. And I think it has paid off. Before they get too used to you or familiar, you move to another entity, resign, let another person take off the engagement. Because internal auditors are much more threatened. They see you, especially Objectivity, as a threat. Management to be like, everything you'll be flagging. We are the ones paying your salary now. So Objectivity also applies to internal auditors. I just needed to chip that in because personally I go through such threats also as internal auditor. Okay. Yeah, you're welcome. Okay, so speaking to temporary staff assignments, it's allowed with strict conditions and
sorry, sir, can I just interject a little bit?
Yes, please. Freely interject. Let's share our thoughts together.
You just made a point. In fact, I've been warming up with this question, and then you directly hit the nail on the head. Regarding the internal auditors and the extent of their objectivity. You just made a point. We are paying your salary. That is coming from the management. Looking at it from that point of view, sir, how objective can an internal auditor actually be, considering the scope of their duty, considering the fact that the management, there is management influence, to a great extent as far as their existence is concerned. How objective can an internal auditor actually be? Most times, when the subject of independence and objectivity, when they come up, I always narrow it down to external auditors because theirs is a lot more understandable. But for an internal auditor, he seems to be roped in, kind of, and then exercising that sense of objectivity becomes even difficult. So how can that? To what extent are they actually, can they be objective? Are they actually independent?
Fantastic question. Kai, I love this question. Now, I will speak from experience, not just theory. Now, in my last place of assignment.
Sir.
Yes, please. Yes, please.
Sir, before you go further, I would also like to ask this from a colleague. Now, and I've also asked you this question, if you can remember, that I probably chat you concerning this. I've seen a scenario whereby a group HR will be threatening an internal control officer in an organization.
Yeah.
The independency is not there. a case of this of recent.
Yeah.
One of is a colleague. He has to join another organization. To the extent that the group HR is asking him, "What are your job descriptions?"
Can you imagine?
It become a threat. Intimidating the. And I look at it that you are supposed to be reporting to the management. How come the group internal control now become a shark? Become a bulldog? So this is a live experience. That's why there was a time I sent a message to you. If you remember, sir.
Yes,
and
I remember.
Respond. Independence of internal. Thank you, sir.
All right. Thank you so much for that practical. Yeah, thank you so much. In fact, these are practical realities that we have to face as internal auditors because we form the third line of defense. So in my last space, yes, please, AA, interject freely. Yes, please.
Okay, before you wrap up with your conclusion on that, I just want to give my own thoughts to it. You know, yes, I think it's even wrong. What I will say about it is that internal auditors, if we really want to be structured as a business, should not even be reporting to more or less like the management. There should be more or less like an audit team, audit committee, whatever, that would be able to take in the things that internal auditors are suggesting, and they will now be taking that forward to the board, because management will just tell you that I'm the one that recruited you, as a matter of fact. So I can hire and fire you. So that dependence will be very, very, one will be threatened, basically. So I think structure wise is one thing that would really help align all those things.
Sorry, sir, once again.
Yes, please go ahead. Can you wait? Let AA land, please, Keller, before you speak. AA is trying to land on a point.
No problem.
All right. Yes, all right. AA, please go ahead, please.
Yeah, just like I said, structure is what is very needed. Is key. Now, having a kind of organizational structure that would help the internal auditor know these are the people you report to, and these are, if you have anything that needs to be escalated, you can escalate to so and so committee, basically.
Exactly. Thank you so much for those thoughts, and I agree with them absolutely. Yeah, Keller, you wanted to provide context, say something before I speak.
Yes,
please go ahead.
Just a follow-up on the most recent response here. I could hear him. If I could hear him clearly, he was mentioning about structure and the fact that there should be a line of communication between the internal auditor and audit committee.
Yes.
Now, I stand to be corrected. I think audit committees have more to do with external auditors, and then looking at the scope, sir.
Yes, plus internal, but go ahead. Yes, plus internal.
Plus internal, yes. But looking at these internal auditors, I think their scope is purely they are limited in the scope in terms of escalation, and that is why I'm looking at it, because of their terms of appointment and everything. They seem to be directly under management's dictates and oversight. And that to an extent, affects the extent to which they can shake their operational boundaries, and that is hitting hard on their level of independence too, and this issue of objectivity. That's just what I want to chip in there, sir.
Okay. Thank you very much for those thoughts and align. These concerns are permeating, in fact, they are prevalent currently in the office and business space. Very prevalent, because There are organizations where you see the internal auditor report to finance manager. I'm telling you, somebody that is supposed to check the finance manager reports to the finance manager directly. I can't work in such space, in such environments. I can't. So before I take up a job, I look at this independence criteria very critically. Now, look at what AA said and take some very clue from what he said. Structure. I look at a structured organization that fits my independence or the profession's independence before I even accept the employment. Now, my former business space, look at the structure that was put to make the auditor very, very independent and speak unequivocally, write any report he likes, and he doesn't report to one line. Now, let me tell you my recruitment process with my last space. The first team I met was HR. The second team I met was the internal audit team, 3 of them from the group. I was being recruited for a subsidiary. So I have a dotted reporting line to the group head of internal audit. Then number 3, I now met the CEO, management. Then HR now ratified the employment. So when I saw that independence platform, I was certified. So I asked HR in the final interview, I said, who do I report to administratively? They said management. Then I said, who do I report to functionally? You see, the internal audit function has 2 or dual reporting line, not one. So where you make it report to management, he'll be pocketed. So he should report to management administratively. Of course, your day-to-day reviews, month to month, should be reported to management for resolution. Then quarterly, yearly, you report to the board or audit committee. You see, it will enhance your independence. When you have a dual reporting rule to management and to audit committee or to the board, you see, you will be dependent. If anything management wants to pocket, you will report it to the board of directors or to the audit committee. They can't pocket you. And to even help me in my former space, the healthcare space, I can report also to the group head of internal audit. The subsidiary auditors were autonomous. They have a board. The group area or the group company was also autonomous. They have their group. So you don't report to them alone. You have 3 reporting lines. You can see the audit function was properly empowered. In fact, the group head of internal audit to call me, hope there are no issues. Is there any problem? I reported something about the going concern of Umahia, and the CEO called me. Josiah, do you want me to lose my job? I told you I was working on this. You see my independence? Because he too took it to the group head, took it to the board and reported it. That helps the internal auditors independence of mind and of appearance. Have structure in AA's words. It should not report to one person. Of course, you report to management. You can't go to the audit committee and say, look at what they've done. Of course, you say management, see what you are not doing right. Have you remediated it? Have you resolved it? You can't bypass them. It's like reporting them. You let them know of your findings and look at their attitude towards resolution. That's why you have to report to management for administratively. Then functionally, the issues that have been resolved and those that have not been resolved, you take it to the board or to audit committee. That's the proper structure for the audit function. Very important. But where you hear he reports solely to management, I saw one very terrible one, a big NGO, I won't mention the name. The auditor reports to the finance director, and I said, no, this is wrong. And in recent times, unfortunately, 2 months ago, I learned they've sacked the guy. Management sacked the guy because he reports solely to him. They pay his salary. They pay his salary, and that's the concern Keller is raising. Where you report solely to management, don't even take the role. During the interview, you just know they are going to frustrate you. Except if you don't want to be objective, you just join them in all the guguru they are chopping. But if you want to really do the internal audits, there must be dichotomies and there must be different lines of reporting for you. Very, very important. So thank you for bringing that to the fore. The internal audit function, normally And that is why, to some extent, the Big Four relied more on our work. Because when they look at my reports, I do risk, I do compliance, I do internal audits. If one day the audit manager from PwC called me and said, man, Josiah, they work, these your slides. Because he would go through my audit committee reports, go to my management reports, and he was like, man, you are working. Because that's what gives them that level of assurance that the internal audit function is robust and doing what it's supposed to do and independent. So thank you for bringing that to the fore. That concern that he reports to management alone has already flawed the purpose of internal audits, because they will subdue him, silence him, and at worst or at best even sack him one day, and nothing can be done. Yeah, so thank you for this conversation. It really resonates and is good with proper context. So before you take up a job personally, and I moved from the healthcare space to the mining space, and let me tell you what they did to ensure that the independence of the auditor is safeguarded. I was recruited at group level. I was coming to report to I was coming to work in one of their franchises, another big company, but I was recruited from the group. So my salary is not even coming from where I'm working, one of their franchise. I'm being paid from the group, from Lagos. So in Kano, they don't even know how much is my pay. They don't know my modus operandi. I work with the group head of internal auditor. So that group has a different name from even this company here. So nobody gets my payroll. Whatever it is, I send to head office. I just do my job, work with management, and I also send to the group head to look at and ratify. Then he also reports to the board. So you see that level of independence and of appearance and structure made me take the job. If I was reporting here, they prepare my payroll here, they detect how I work here, I mean, I can't be independent. And that is why anytime I'm around currently in the office, they are very careful. Be careful with the auditor. They don't even know about you. They don't know how much you earn. They don't know what you are doing. All they see is findings, respond. That's how to make the internal audit function robust. And it makes the external auditors very, very free and relaxed. They know that the auditor is doing his job and it's just few findings he could pick or make them concentrate on their financial statements they are asked to audit. So thank you for bringing that. And please don't take a job that does not have these structures. As internal audits, you will be frustrated. You may just be earning salary, but then you are not happy. You're not doing what is right based on the Institute of Internal Auditors Professional Practice Framework. Okay, so I've spoken too much on that, and I hope, Kella, you are okay now with my experience and
that is very okay, very exhaustively handled. Thank you so much for that.
Oh, thank you. I appreciate that. Thank you, because I'm happy you accept that. So it's good we share these experiences and they help us to address case studies, which mostly is what we are faced with. We are faced with case studies, not just define, explain, say this in the case in the AAA paper. So it's good we share these experiences to help us understand the subject very much. All right, so speaking to the guard, we have just 5 minutes to wrap up this session. The second opinion is talking about getting clients' permission to contact existing auditors. And if refusal is not given, most auditors that are taking over the job of another auditor based on the mandatory rotation or something happen, resignation, have to contact the former auditor. You have to know what's happening, what happened that you resigned the job. Is it a landscape I'm navigating that is dangerous? Tell me what's this client all about. And that's why professional accountants need to work together. We need to work together. You can't, because of a job, ignore all the red flags the former auditor has flagged or the reason for his resignation. So you need to contact him. Then the area of specialist valuations, Sammy spoke to that. We are restricted to take over jobs we don't have a requisite experience. That's part of professional competence, like Sammy said. So specialist valuations, restriction, if material and subjective, especially is prohibited for public interest companies if it's material. So specialist valuation for public interest companies is prohibited. You have to get special approval to be able to do that. But for public listed companies is allowed. Specialist valuations, experts reviews should be done and is allowed under the public listed space. Yes, please. Olamide, you want to say something? Your hands are up. Please go ahead. Yeah. Good evening. It's nice to have you, Olamide.
So if I've been on transit, so I just got in now. So I've been following you, but I could not say anything because of the media.
Oh, okay, understood. It's fine.
Thanks for doing
yes,
that.
Please.
I wanted to have what period. What's the reason?
Sorry, I am struggling to hear you. Please, can you be a bit audible?
Pulling off period. So I wanted to know what the reason is. Like, what the reason? Why would an internal and external auditor go for pulling off period?
I'm serious. Yes, I'm hearing you, but it's fainting. I'm trying to catch what you are saying. I'm struggling. I don't know if somebody else is hearing her. Sorry, if you caught her thought, please, can you explain what she asked? Because I'm struggling to hear her. She's even muted now. Can somebody share?
I just type it in the chat box.
Oh, okay. Yeah, okay, we can hear you now. Olamide, please go ahead. We can hear you.
And so what's the reason for cooling off period?
Okay, for cooling off for auditors.
Yeah, what's the reason for it?
Okay. I think I caught that. All right. So Sammy brought that to the fore, and cooling off speaks to a time period where auditors will have to stay away from an engagement they've been handling for a long time. So essentially, the reason for cooling off is to avoid familiarity threat. That's essentially what cooling off is all about. So the reason is to avoid familiarity threat or conflict of interest. And the idea, like I said earlier, in speaking to clearly what Sammy brought about, is that if an auditor is heavily involved in auditing a client's financial statements, they may carry biases, knowledge of weaknesses, or personal relationships that could compromise independence if they immediately join a client's management. So in the area of staying too long on an engagement or wanting to move from the audit team to the client's team is the reason for cooling off period. Essentially, that's why auditors are mandated to have that cooling off period, and ICAN has given auditors under ICAN that want to transit from the audit firm to the client's team a 12-month period, at least stay off the client's audit and the financial statements for 12 months before you join the team. That's what it means. All right, I believe you heard what I said on that. Okay, I think she's having network challenges.
Thank you, right. Sir. Thank you very much, sir.
Oh, okay. All right. You're welcome. Okay, so that's it for speaking to the threats to independence, which is primarily what comes out in the case studies I looked at from the chapter 3 questions. So we'll take our time. Maybe in the next class, we'll try to see how to wrap up this so that we can go into the past questions and answers. It's already 10:01. I would like us to stop here